Can you make your money last forever? Most financial planners swear by the 4% rule for retirement. But what if I told you that in the worst market in history, that rule would have bankrupted you in just 20 years? Today, we are testing the art of investing for perpetual wealth by pitting the classic 4% withdrawal strategy against a conservative 2% strategy across 50 years of market history. Here is the scenario. You are 35 years old. You have $1 million in initial capital. You invest it all into the S&P 500 index. Your horizon is 50 years. But here is the twist. We are going to test this exact strategy in two very different worlds. First, the best realistic period from 1975 to 2025, a time of recovery and tech booms. And second, the worst possible period from 1929 to 1979, covering the Great Depression, World War II, and stagflation. We have two contenders. On the left, the 4% withdrawal rate. You take out $40,000 a year, adjusted for inflation. It's the classic rule of thumb, but it carries a high risk of ruin over long horizons. On the right, the 2% withdrawal rate. You take out only $20,000 a year. This is the endowment approach used by universities to preserve their funds forever. Let's see how they perform. First, let's look at the favorable period, 1975 to 2025. As you can see on the chart, both strategies grow massively. The 4% investor ends up with a staggering $184 million by age 85. Not bad, right? But look at the green line. Because they withdrew less, the 2% investor ends up with $261 million. Even in a booming market, spending less made them significantly wealthier. Now, let's travel back to 1929, the worst possible moment to retire. The market crashes, wars break out, and inflation spikes. This is where the 4% rule faces its doom. Look at the orange line. It flatlines. By 1949, just 20 years in, the portfolio hits zero. Total ruin. But the 2% investor? They didn't just survive, they thrived. They ended with $16.62 million. The difference between bankruptcy and generational wealth was simply spending half as much. Let's look at the head-to-head comparison. In the worst-case scenario, the 4% strategy resulted in a final balance of zero and a high risk of ruin. The 2% strategy? A final balance of $16 million and a low risk of ruin. The data is clear. In a 50-year horizon, the withdrawal rate matters more than the market timing. Why did this happen? It's a concept called sequence of returns risk. When the market crashes early in your retirement, you are forced to sell shares at low prices to fund your lifestyle. In 1932, the 4% investor's portfolio fell to just $196,000, only 20% of their original capital. One more bad year meant total ruin. The 2% investor, withdrawing less, preserved their critical mass. When the market bounced back in 1933, they had more shares left to compound. So, how do you invest for perpetuity? There are 5 principles. 1. Invest in broad market indices. 2. Start early. Time is the multiplier. 3. Keep your withdrawal rate at or below 2 to 3%. 4. Never panic sell during crashes. And 5. Reinvest dividends. This is the engine that allows wealth to grow indefinitely. Think of withdrawal rates as danger zones. 2% or less is the perpetuity safe zone. Your portfolio grows in real terms. 3 to 4% is the caution zone. You might survive, but an early crash could kill your portfolio. Anything over 5% is the danger zone, where high probability of depletion becomes a certainty. Here are the key takeaways. Even the worst timing in history couldn't defeat a disciplined investor with a low withdrawal rate. The withdrawal rate matters more than market timing. And finally, 2% is the key to true perpetuity. It allows your portfolio to outlive you and your heirs. Invest consistently, withdraw conservatively, and stay the course. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Past performance does not guarantee future results. Always consult a qualified financial advisor. You've just seen how we're turning data into wealth. If you want more insights like this, subscribe to the channel. Hit the like button, share and comment below to discuss what similar videos you'd like to see next.